Hello and welcome to our Steps to Investing YouTube channel. My name's Simon and I'm one of the co-founders of Steps to Investing. Each week we're going to have a guest on the show to talk about all aspects of investing, right from starting out to optimizing your investment strategy over time. One thing I would just say before we start is that nothing you'll hear in today's program is what we call financial advice. In other words, we're not going to give you specific tailored advice for your own personal situation, and if you do need financial advice of that kind, then you should head over to unbiased.co.uk where you can find a financial professional in your local area. The other thing to say is that investing does come with some risk. There's no escaping that. We are going to talk about risk quite a bit in today's programme, but you need to be comfortable with risk before you consider investing. Okay, well, let's get on with the show. Today's guest is Amarat Sehgal. Amarat, welcome to the show.
Thanks, Simon.
Perhaps if you could start by telling us a little bit about yourself and what's been your journey on the investment landscape so far.
So I work as a producer in a media company in London, and I have some questions for you regarding investment, what it is that I'd like to do for the future, and what is the best way to make my money grow.
So you're just starting out?
Yes, I am. My first question would be, if I did, I've got some pensions and I'd like to know if I should be investing in other pensions as well as my contribution to my one that I have right now.
So pensions is a really meaty topic, and actually you started right at the complicated end of investing, if you like, which is it's not a problem at all, but it does get complicated. So let's just take a step back a little bit. Let's just think about pensions in the round. One of the important things to think about in terms of pensions is the time frame over which you are investing. And the government actually made some changes to how pensions were allowed to be administered back in 2014. So there's a thing called pensions freedoms. Okay. And back in the old days, what would happen is when you retired, your pension would be used to buy something called an annuity. And essentially an annuity, it's hard to say, an annuity was something that gave you a guaranteed income for the rest of your life. So let's say you retired and you had a pension of £50,000, and you could use that £50,000 to then buy an annuity, and forevermore until you die, you'd get paid a certain amount every year. Well, what the Chancellor then, George Osborne, did was people who had been previously forced to buy annuities, what he did was allow people to say, right, well, I don't want an annuity, I just want to keep all my investment and stay invested, stay in the stock market, and actually just use the income from those investments to pay my pension. And so that was a massive change. So one of the decisions you'll have to make when you retire is about what you want to do with that money. Do you want to keep it invested, or do you want to take an annuity as you would have done historically and just have that guarantee of an income? The problem with annuities, by the way, is if you were to die the day after you retired, all your pension money goes to the pension company and nobody ever sees it. If you were to keep that money invested, then essentially that becomes part of your estate and your heirs could take that.
I would just want somewhere where my money is either going to grow or I have a second income coming in and I don't have to worry about that.
Yeah, and are you comfortable with the idea that over time might be going down as well as up? I mean, or are you looking for something that's more kind of guaranteed?
More guaranteed, which is why I was thinking about having different pension schemes, which is why you've got one that may be in a high category, but then somewhere in between in the middle, but then you may just get, depending on what's happening with the economy, you may just get something big back with the higher risk. But as you said, it does depend on the economy as well.
Yeah, it does. And of course, you could, within a single pension, invest the money in different ways. So actually, this is what your pensions professional would do. He wouldn't go and put all of that money. Let's imagine you had £1 million pension. He's not going to go and put all that money on red or black. That's just not how it works. If a professional was managing a pension portfolio, what they would be doing is keeping some in cash anyway, because cash is a safer asset class, but then they would also look at your time to retirement, how long is the investment going to be made for, but potentially also then look at different types of investment that may or may not be riskier. So, for example, they might have a small proportion of your pension in riskier assets. So, things like perhaps emerging markets. So, maybe the emerging economies of India, China, for example. They might have a lump of money in perceived safer economies, so more developed economies like our own or the US, Australia. And that gives you that kind of different, what we call exposure, so that when the market does change over time, that you can take advantage when things are growing, to your point, but also you've got a kind of safer aspect to your portfolio. It's actually called diversification as the technical term, and it basically means just not putting all of your money on a single thing.
Okay, so would it be best to have 3 or 4 different pension schemes then that I would contribute to, or was it best just to stick to one?
Stick to one, okay. So why are you thinking that more than one might be more helpful?
I'm scared with pensions, and I think with what we've experienced through the recession, I'm wondering whether I should just have a few pension schemes or whether I should actually invest in purchasing another house and keep that as my income. I'm trying to think of 2 ways or different ways of what the best thing is, really.
So you're essentially trying to hedge some of that risk. You don't want to put it all on black or red. You want to try and...
It's scary. It's scary business. So I'm trying to think of the best way, which has got less of a risk.
Yeah. Yeah, I mean, even within a single pension, you can take out some of that risk, I suppose. The thing I think you're getting at, though, is what if my pension provider, if I'm with a pensions company and that pensions company goes bust, will I get my money out? And there are no guarantees there. It depends on the circumstances and depends on the company. And actually, most people have more than one pension anyway because they've moved around in their working careers. They may have had 3 or 4 pensions over time with different employers. And so the thing that you need to think about there really is, yes, you are diversifying some of that risk. You're taking away some of that risk, but you're also paying charges. So every pension you have comes with charges to the pension company, and therefore, if you've got lots of pensions and they're small ones, it might be worth thinking about consolidating those into maybe a larger pot with a smaller number of providers. The other thing you mentioned was property and the difference between a pension that's invested in the stock market and a pension that might come out of property, is that right?
Yeah, so just keeping that property solely to rent out and then just have that income coming in, obviously covering costs for the bills, but then having that almost as a second small income as my pension as I get to retirement age.
Yeah, and lots of people historically have used property as their retirement, either by having a big house and downsizing when they retire, so the children have fled the nest and you don't need so many bedrooms, you don't need so much space, so you don't have a mortgage potentially, so actually you can just buy a smaller property and use the difference between the bigger property value and the smaller property value to live off. But the other thing that you need to look into when it comes to keeping a property and taking an income from it is some of the recent tax changes that came into play in the last couple of years about landlords and how much they can take in income and the tax that applies to that. It gets quite complicated, so I'm not going to go into the details, but it's worth checking that out.
That's interesting. So if I was to inherit a lump sum of money, again, would I be better off putting that into different ISA accounts or keeping that into one big account? What would be the best way to invest that money?
So there's something called the Financial Services Compensation Scheme, which really came into focus after the financial crisis. So you remember way back in 2008, there was what was called a run on the bank. In other words, Northern Rock didn't have enough money to pay. People were queuing outside trying to get their money out, and people became much more focused. It wasn't just Northern Rock, there were other banks, but people became much more focused about kind of spreading their money to different institutions to minimise that risk. So the compensation scheme helps with that. There is an amount up to which you are covered with any single organisation. But the other thing to think about in terms of you inheriting a lump sum is then perhaps the difference between saving, holding that as cash, and investing. and putting that money to work in the stock market, essentially. So if you're holding something as cash, you would probably put some of it at any rate in a cash ISA. So an ISA is an individual savings account, and essentially it's a government scheme to help people get a more tax efficient way of keeping money. The problem with that, especially from a lump sum point of view, is that you're only allowed to put £20,000 in an ISA in any one tax year. So let's imagine you inherited, I don't know, £40,000. Mm-hmm. You could put £20,000 in an ISA, cash ISA right now, but what would you do with the other 20? You couldn't put that in an ISA in this tax year. The other thing to think about in terms of cash ISAs, if you go to something like moneysavingexpert.com, they will give you a comparison of different cash ISAs, amongst other things. The best rate currently I could find was about 1.3% in terms of the interest you would get. So for every £100 you had in your cash ISA, you'd get £1.30 every year. Now, if you think about something called inflation, which is the fact that your money is worth less as inflation goes up, so inflation's running around 3%, that 1.3% is actually less than the money is eroding anyway.
So it's still best to look at the interest rate, but also look at the inflation rate as well.
Well, it is. So back, again, in history, interest rates have never been quite so low for so long. I mean, we had an interest rate rise a couple of weeks ago, but even at 0.75%, which is the current interest rate, average over time has been 5%. If you look right back to the beginning of interest rates, it's 5%. So we're still running at really low historical interest rates relative to history. And so you've got to think, well, is that the best way of getting a return on my money? Now, the thing about cash, of course, is it's safe. You can put it in the bank and you can withdraw it at any time. The thing about investing is that you should consider that investing is a longer term opportunity. Typically, we say that you should think about investing as a 5-year time horizon. So if you're wanting to put money in the stock market today and withdraw it in 6 months' time because you need that money for something else, then that's probably going to be difficult, because in 6 months' time, you haven't really had enough time for that investment to grow. Investments tend to grow slowly over the longer term.
Sure. So do you think that we would be going for another recession, say?
Well, I mean, that's $1 million question, isn't it?
Maybe in the next 10 or 20 years' time.
Well, I mean, inevitably the economy works in cycles. If you think back over our lifetimes, there have been good times and there have been bad times. And most recently, back in 2008-09, in the last financial crisis. You've got to think that we're 10 years on from that now. So where are we in the cycle in terms of the economy? Can it continue to recover and go up in the way that it has? The short answer is it's difficult to say, but it's a good question. The thing, of course, you should think about is that in terms of a recession, if things were to be more difficult, then what tends to happen is that the value of assets, the value of investments, tends to come down during a recession. Now, if you're a first-time investor looking to put money into the stock market, logic would say, well, surely it's better to buy things when they're cheap rather than to buy them when they're really expensive. And so actually it might be an opportunity for an investor to take a look at the market during a more difficult time, to think, well, actually, these things were expensive a year ago, where are they now? And are they likely to go up in value in the future? That's, I think, the question you've kind of got to ask yourself. Okay.
So would I still have a risk if I invested money during if we did have a recession, for example?
Yeah, the risk never goes away. So the risks really you're thinking about are the risks of the return. What is the return I'm going to get over time? And time is a really the key word there. As I mentioned, investing should be really thought about as a long-term endeavour. And one of the things that, one of the kind of old adages of investing is it's about time and not timing. So if you've got a 40-year time horizon to think about for your investing, then the time at which you invest is much less important than if you've only got a 3-year time horizon. to think about your investing. And the reason for that is that, generally speaking, over time, if you go back to when investing started and look at all of the period since then, and Barclays do this every year, Barclays Bank do this every year, they publish a study and they have shown that over time, markets tend to go up. Yes, there's volatility along the way and things go up sometimes and things go down, but generally speaking, over time, things go up. And that's why having time on your side is a good thing. Having a long-term time horizon to think about investing should help you out.
Okay. I don't have too long, that would be saying. So are there any alarm bells I should be thinking about if, in terms of if there was to be a recession? Is there anything you could sort of pick out that's going to happen before it actually happens?
Yeah, that's a really good question. If you again think back to 2007, people were thinking, well, house prices surely can't keep going up at this rate. You remember that?
Yeah.
And what happened was, and it came mainly from the US, although it did happen here as well, was that people started to default on their mortgages. They couldn't pay their monthly mortgage payment. And actually, if you again look at the historical data, what you can see is that that was an early sign that things were beginning to go wrong, because a lot of this, a lot of the crisis was really built around the fact that people had been sold mortgages they couldn't really afford in many cases. And so when they started not to pay their monthly payments, there was a kind of indicator that things could potentially have looked bad. Having said that, very difficult to say. And will that happen again this time around, the next time there's a problem? Well, I mean, that's really anyone's guess. So I think you're asking a really tricky question there. And again, depending on who you talk to, if you think about professional investment managers, the ones I talk to are saying, well, actually, jobs data is really, really good. Companies are really in good shape. So what would be the trigger? What would cause people to lose confidence and for the market to turn? And the answer is, we just don't know.
Okay, so would now be the best time to actually invest in some money?
Well, again, that's a really good question. I mean, I can't give you financial advice. I can't say that now is as good a time as any. But I do think if you go back to this idea of time, not timing, that actually getting into the market at any point for the long term should be better than not being in the market. If you thought maybe, I don't know, let's say 3 years ago, well, we're in a really good place, it can't go any better than it is now, you'd actually missed out on some great returns, because in the last 3 years, things have continued to get better, markets have continued to go up. But it does come with this risk, and that's why if you can afford that time, if you have a 5-year plus time horizon, then you're in a better place in terms of investing.
Okay, that sounds great.
Okay, well, thank you for joining us. Thank you for your questions.
Thank you for your answers.
You're welcome, and thank you for watching. I hope you enjoyed the programme and found it useful. We're back again next week. If you do have more questions, then head over to stepstoinvesting.com or check out the playlist. Thanks for watching.